So we have a lot going on right now. We've got the Strait of Hormuz, we've got the Iran war, we've got FOMC last night, interest rate decisions, and there's just a lot going on for us to really unpack what truly matters and what's just noise. So let's quickly dive in and have a look at this. So first thing is the illusion of uncertainty. This is what most people think matters. And I've just been continuously seeing the same pattern of most people reacting to what's already priced into the markets or what's irrelevant completely. So we've got news coming that, the Fed's holding rates steady. That was last night. And we've already expected this. Interest rates were priced into the markets 99% already. So to jump over headlines or make drastic portfolio decisions because the Fed's holding rates steady is just totally naive. So I've seen it over and over again. People are making investment decisions based on news, based on headlines, and they don't understand that some of the news that's happening is irrelevant or the market's already priced this stuff in. So what actually drives the market? What's the real drivers here? We need to be focusing on things like liquidity, interest rates, and capital flows. Now, what liquidity essentially means is how much money is available in the system to invest, to lend, and to take risk. So we want to see, is liquidity expanding? Is there money flowing into the system, or is liquidity contracting? Central banks can influence this by either tightening or easing, and we can also take a look at things like credit conditions. Now, if we just quickly look at the S&P 500 versus global liquidity, you can see a strong correlation over a good couple of years. Whenever we get global liquidity expanding, when money's flowing into the system, we tend to see risk on assets like the stock market doing really well. And then the same goes for credit. When it's easy to take out loans, when it's cheap, we can see the overall GDP of the economy doing really well. You can see a strong correlation here too. When credit's expensive, when it's expensive to take out loans, the GDP tends to drop. Now, when liquidity is expanding, more money enters the system, it's easier for borrowing, there's going to be more risk taking, and we tend to see risk assets like crypto and stocks doing really well. And when liquidity is contracting, money is being pulled out the system, lending slows down, risk appetite drops, and of course assets struggle or become more volatile. What actually controls this? So we look at a couple different things. QE, QT, which is quantitative easing, quantitative tightening. We've got the central bank balance sheets, and we've got money supply. For example, the Fed balance sheet. We can see the total assets and the effect that that has on the markets. I mean, this was 2020. We saw that the moment the Fed started injecting liquidity into the markets, we got the crypto bull run, we got that bull market rally from stocks. And at the moment we are on a slow decline, we have been contracting, but it does look like we're slowly starting to bottom. So potentially, if the Fed, does start injecting liquidity, we could see this balance sheet increase again, and we could start looking at, potential bullish narratives or scenarios for both risk on assets like the stock market and crypto. Now, in terms of the central bank balance sheets, when they expand, money is obviously being added into the economy, which is what we call quantitative easing, QE. And when they shrink the balance sheets, money is being removed, which is quantitative tightening. So you can see that obviously how it affects the markets. We saw back in 2020 when we had a strong cycle of QE, that's when the bull run happened, and that's when we started getting a strong bull market in crypto. So what does this actually mean overall? If we go to the current macro backdrop, which is happening right now, of course, we've got energy, we've got oil creating inflationary pressure because the cost of oil is affecting companies, it's affecting transporting companies, it's affecting airlines, shipping, it's affecting cost to produce. It's basically affecting everything. Oil's the main driver right now. So we had a look last night that Trump holds talks on prolonged Iran blockade and urges Tehran to reach a deal. And just based on that, we saw the dollar rally this morning, just breaking above these highs here created a couple days ago from last week. So just breaking these highs here, we're seeing gold roll over a little bit more. Now bear in mind, everybody's confused. They say, oh, well, Zach, gold's a safe haven. Why is gold not going up in times of geopolitical uncertainty? Well, gold, yes, is a safe haven, but it's not the only thing that it gets driven by. It's driven by things like interest rates. At the moment, we have interest rates that are really high. Gold doesn't pay dividends. It makes more sense for investors to put their money into the banks, into the dollar, where they can get a good yield. And that's probably why we're seeing gold slowly start to roll over. If we compare gold to the interest rate charts, we can see a highly inverse correlation where when interest rates are low, we tend to get more of a rally on gold, and when interest rates are high, that obviously creates a bit of a pressure. So yes, it is a safe haven, but there's obviously a multitude of factors that affect the price of gold. So let's quickly jump back here. We've obviously got energy, which is creating inflationary pressure. With the sticky inflation, central banks are more cautious because they don't want to cut rates too soon and encourage spending because that's going to increase inflation even more. They're very cautious now about how they want to cut, when they want to cut, and this is creating now a strong US dollar environment. US dollar is classified as a strong, stable currency, so a lot of investors are flocking towards the dollar where they're getting high interest, they're getting guaranteed interest. So yes, current macro backdrop, global uncertainty, we've got growth slowdown and obviously geopolitics, Strait of Hormuz, we've got the trade deals, just a lot of tension happening overall right now. So in terms of market implications, what that means for assets. So if we look at gold versus real yield dynamics, this is the chart that I was showing you. Like when yields are high, gold tends to not do so well. We can see that here we've got 10-year yields that were rallying and then gold was selling off. Once again, reason being is gold doesn't pay dividends. So that's a market implication that as interest rates stay high, that could be adding more pressure to gold. As we start tightening liquidity, we're going to be having more choppy or unstable markets. High yields is going to be capital that's pulled from risk assets. So that's money coming out of risk assets like the S&P 500 and being put towards the dollar. Now, if we look at the S&P 500 chart here, we can see we had a pretty strong rally over the last 2-3 weeks. And usually what happens after a rally is we see a lot of profit taking. And I think combining that with macro influence, that if we do get a drive again from the S&P 500, maybe into this fib extension here. So basically I drew this fib from these lows into the highs. We pulled back into that 61.8 pocket where we got that rally. And I think that for the next maybe couple of weeks, we could be stalling out with a bit of indecision. And then we could potentially start seeing a rollover from the S&P 500 if rates start to stay high and considering that we are overextended already. I can bring on an indicator. Let's have a look at what the relative strength index looks like at the moment. Currently edging towards being overbought, not quite overbought just yet, but I think as we start edging towards that overbought mark, we could be leading towards profit taking. So if you guys do have a longer term approach, you're doing your dollar cost averaging, that's perfectly fine, but definitely not wanting to invest lump sums with S&P 500 into highs at the moment. We'd rather wait for price into discount, we'd rather wait for better buying opportunities before sizing in more aggressively. And I think with the strong dollar approach, we can see that inverse correlation here. So I've just compared this chart here with the DXY, and we can see that inverse correlation that when the dollar's doing well, when the dollar's rallying, we tend to get a sell-off from the S&P 500, and we can see how capital rotates from one market to the next based on what investor sentiment's looking like at the moment. So we can see here where this was kind of like a consolidative period, we had that stall out. And then the moment that we got that drop from the dollar, a lot of liquidity being pulled out the market, put into risk on assets. And I think that now just looking at the dollar, based on price action we like to look at, we can see that we've got a strong couple spikes into the lows here. So we had dollar spiking to the lows 1, 2, 3, 4 times into the lows. So getting some strong buying pressure at these regions, sellers really failing to hold price down into these lows. And then beginning of the year, Jan, we kind of got that strong drive to the upside, taking these highs out. So I want to kind of see now that, we got that strong drive to the upside after receiving that bullish pressure to the downside, is this a correction now holding into these demand regions? Once again, 61.8 fib demand, do we hold into these regions and get an extension and a strengthen from the dollar? If that's the case, that's going to be strong pressure on risk on assets like Bitcoin, S&P 500, and also gold. Let's jump back quickly here. And then as we marked here, strong US dollar is going to be pressure on crypto and equities. So that's where the real focus is, guys. I think a lot of us have been focusing on headlines. We're focusing on what the FOMC is going to be about. And essentially what we want to do is, in terms of positioning and mindset, focus on what actually matters for you. Stop reacting to headlines and focus on macro and direction and not the noise. Understand the environment you're trading in. Are we in a liquidity phase where we're expanding, or are we contracting? Are we in QT or QE? Are rates high or are rates low? Do we have inflationary pressure? This is going to impact overall drive. This is the real drivers on the market. It's not your basic trend lines that everybody looks at. And then, of course, managing risk over prediction. At the end of the day, our main priority is to manage the risk. Yes, we want to look for good opportunities. Yes, we want to look for alpha. We want to package portfolios. We want to have good asset allocation. But through good asset allocation comes good risk management, and we need to focus on managing our downside, knowing when to put positions on, but also when to reduce risk, when to size out. Warren Buffett was cash heavy for a long period of time. So he knows when to deploy. He's not looking to buy aggressively when stocks are into all-time highs. So patience in uncertain conditions is key here. So let's quickly jump back to the charts and we can have a quick rundown. Brent crude getting a strong driver this morning, just taking out these supply zones, just ripping straight through. So it looks like we're going to get a lot of pressure coming through here to the upside from Brent crude, looking to take these previous Iran war highs out. That'll be quite interesting. Now Bitcoin is an interesting one. If I just quickly mark up Bitcoin and we compare it to the dollar here, let's compare Bitcoin to the DXY. And I take this. We can also see that inverse correlation where, when we get a strong rally from the DXY, Bitcoin doesn't do too well, broke above these previous yearly highs, broke above previous monthly highs. And now favoring that dollar bullish scenario, if that's the case, we could see a bit of pressure coming from Bitcoin trading into these previous monthly highs, now breaking back below. So we want to see potential, hedging opportunities. We could come back into these monthly lows here and we could see some pressure from Bitcoin considering interest rates are high, considering the dollar's doing well. That could be some bearish pressure for Bitcoin. If we just look at, broader perspective, technical analysis, we had these runs to the downside, that corrective structure that's being built. We had these runs to the downside, now new corrective structure. So we want to see, based on this corrective structure, we had 1, 2, 3 spikes into the highs here, and then of course 1, 2, 3 spikes into the highs. Again, is this that third spike that potentially brings Bitcoin lower? Or, do we run lows here, maybe get a pivot from the Fed, and then potentially start seeing Bitcoin set up for, maybe some bullish momentum? If that's the case, great. If not, we're just going to have to manage our portfolio accordingly. I think something interesting too is understanding that price is fractal for more of my intraday, intra-week sort of traders. If I jump down to the 4 hour here, we can see that same thing happen. Get 1, 2, 3 spikes into the highs, and we're starting to hold now lower highs. We're building up all this bullish structure, higher highs, higher lows, highs, lows, higher highs, higher lows. We then created these equal highs here, failing to create new highs, taking out this bullish structure, now holding lower highs. So this is potential, at least off a technical standpoint, and basically aligning with macro view that potentially Bitcoin could be rotating to the downside. In order for this to potentially look a little bit more bullish, Bitcoin taking some lows out here, and then maybe stepping back above, taking out that bearish structure, holding some new bullish structure, and I think that could be potential to start creating some higher highs, higher lows. That could look a little bit better for Bitcoin, but at the moment, Bitcoin technical standpoint and macro bigger picture view not looking really good at the moment. S&P 500 we broke down, oil we broke down, dollar looking pretty solid above these 97,600 regions, holding above this 61.8 fib, holding above these demands. Let's see if we can extend for a new leg to the upside. If that's the case, do we start hedging our positions on gold? Do we start hedging out our positions on Bitcoin, potentially adding some leverage shorts onto the table? If that is in alignment with your strategy, your longer term strategy. If not, perfectly fine. But once again, just brings us back, staying patient in uncertain conditions. So guys, that is a wrap up here. Markets are uncertain right now. This is what actually matters. Focus on the bigger drivers here. What interest rates are doing, where capital is flowing, what liquidity is doing. And then based on that, we can have a look at what makes sense to be placing our money, and of course when it makes sense to start staying cash heavy. I hope you guys enjoyed this video. If you have any questions, shoot a comment down below, and I'll see you guys on the next one.